Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to show you how to do bond valuation. When we say valuation, it means we are calculating the price or value of an investment. This is a basic model or formula we use to calculate the price or the value of a bond. V0 is the bond price. Here we have to include two components. The first is coupon interest payment. The second is the par value or the principal value of a bond, which is usually equal to $1,000. To get the price of a bond, we are basically converting all the future cash flows back to current year, year zero. In other words, the price of a bond is the same as the present value of all future cash flows. I is the discount rate, required rate, or market interest rate. N is the number of time period until maturity. Let's take an example. What is the market price of a $1,000 par value 20-year bond that pays 9.5% compounded annually when the market rate is 10%? Before I show you how to do the calculation, let's understand the meaning of this question first. $1,000 par value. This is the future value that you will receive at the end of the maturity date after 20 years of investment. This is also called the face value. 20-year bond represents the maximum period of this investment. After 20 years, this investment will come to maturity. 9.5% is the coupon interest rate. You will have to convert it into dollars by multiplying it with the par value. Therefore, your coupon interest payment is $95. Market interest rate is the current interest rate people receive in the market from similar investments. And this question is asking you to calculate the market price of this bond. Market price means the present value, PV. To calculate the market price of the bond, you need to use an app called Financial Calculator. You may download it from Google Play Store or Apple App Store. Just search Financial Calculator, you will find it. After downloading it, look for Bond Calculator and click to open it. By using Financial Calculator. First, you need to set the compounding to annually. It means when you invest in this bond, you will receive the coupon interest payment once a year. Now, key in the face value or par value, FV, $1,000. Annual coupon payment, PMT, taking 9.5% times $1,000 face value, equals to 95. Annual yield, this is the market interest rate, IY, equals to 10. Years to maturity, N, equals to 20. Last step, just press price button, you will get the bond price, PV, negative $957.43. Negative sign means this is a payment. You pay $957.43 to purchase this bond investment. So that, every year you will receive coupon payment of $95 for 20 years. At the end of 20 years, you will get back $1,000 face value. Let's look at the next example, which is about semi-annual compounding. What is the market price of a $1,000 par value 20-year bond that pays 9.5% compounded semi-annually when the market rate is 10%? Using Financial Calculator, set compounding to semi-annually. FV, the future value is the face value or par value, equals to $1,000. PMT, annual coupon payment, taking 9.5% times $1,000 par value, you will get $95. IY, the market interest rate equals 10%. N, years to maturity equals 20. Last step, press price. You will get the PV, which is the bond price equals negative $957.10. Negative means this is a payment. In fact, there are many ways to measure bond yield or bond return, such as current yield, yield to maturity, yield to call, and expected return. We will cover these in the following part. First, current yield. The current yield measures the annual return to an investor based on the current price. This is the return you can earn by holding the bond for 1 year. As the market price of a bond will constantly change, the current yield of a bond is also different at varying period of time. Take an example, a 10% coupon bond which is currently selling at $1,150. How much would be the current yield? By taking 10% times $1,000 par value over $1,150, you will get a current yield, 8.7%. Yield to maturity is another measure of bonds return. Compared to current yield, which measures bonds return for 1 year, yield to maturity measures the average return of a bond for the whole holding period. Take an example. There is a 7.5%, $1,000 par value bond that has 15 years remaining to maturity and is currently trading in the market at $809.50 with annual coupon payments. 7.5% is annual coupon interest rate. Multiplying with $1,000 par value, you will get $75 coupon interest. $75 over $809.50, current yield is 9.26%. This is the return for the bond in current year. To calculate the yield to maturity, YTM, it is basically the market interest rate or annual yield, IY. Using financial calculator, set compounding to annually. PV, the current trading bond price, equals to negative $809.50. Negative sign represents a payment. FV, the future value is the par value, equals to $1,000. PMT, annual coupon payment, taking 7.5% times $1,000 par value, equals to $75. N, remaining years to maturity equals 15. Last step, press yield. You will get the IY, 10.01%. This is the YTM of the bond. Compare the current yield and YTM. YTM is higher than current yield. Therefore, for holding the bond for 15 years, you will get a higher average return. Holding the bond for 1 year will only earn 9.26%, the current yield. The following is another example for calculating the YTM of a semi-annual compounding bond. Find the yield to maturity on a 7.5%, $1,000 par value bond that has 15 years remaining to maturity and is currently trading in the market at $809.50 with semi-annual coupon payments. By using financial calculator, set compounding to semi-annually. PV, the current trading bond price, equals to negative $809.50. Negative sign represents a payment. FV, the future value is the face value, equals to $1,000. PMT, annual coupon payment, taking 7.5% times $1,000 par value, you will get $75. N, remaining years to maturity equals 15. Last step, press yield, you will get the IY, 9.97%. This is the YTM of the bond. If the bond is callable, we may calculate the yield to call, YTC, as a measure of bond's return. Let's take an example. A 10-year, 8% coupon bond, with a par value of $1,000, is currently selling at $940. It is 5-year callable with a call price of $1,080. To calculate the YTM by using financial calculator, set compounding to annually, PV equals negative 940, PMT equals 80, FV equals 1000, N equals 10, and you will get a YTM of 8.93%. However, to calculate the YTC, PV and PMT will be the same, but FV and N will be different. FV equals to the call price, which is $1,080, while N is the callable year, 5 years. By computing the market interest rate, IY, you will get the YTC, 10.91%. YTC is usually higher than YTM, it's because callable bonds are deemed to be more risky. Expected return is used by investors who expect to actively trade in and out of bonds, rather than hold until maturity date. It's similar to yield to maturity. But the estimated market price of bond at expected sale date is used to replace the par value. Let's take an example. Find the expected return on a 7.5% bond that is currently priced in the market at $810, but is expected to rise to $960 within a 3-year holding period with semi-annual coupon payments. To calculate the expected return by using financial calculator, set compounding to semi-annually, PV equals -810, FV equals 960, PMT equals 75, N equals 3, and you will get the annual yield, 14.41%. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.